Ladies and gentlemen, the bank comes out with a whole bunch of forward guidance on the regular basis, but sometimes they do these financial stability reports. These financial stability reports are so important, and I actually think that the bank is being super honest right now. I haven't seen them this honest in a long time. So they're answering a lot of the questions that everybody is having. So I watched the entire meeting so that you don't have to, and I'm going to break it down to the important points that you have to take away. Now, this meeting took place in Canada, but for all of our American friends, I can tell you that the story is the exact same. So, the exact same points that we're going to be summarizing all together are the exact same things that are going to be happening in the United States of America for our American friends. So, let's get into it because I got a lot to cover here. And I mean, a lot of really good pieces of information. All right. So this is the Bank of Canada, and Tiff Macklem is there. So I am going to curate for you a couple pieces.
Is the bedrock of a stable, well-functioning financial system. And financial stability is a precondition for price stability.
Did I miss that?
Stability and price stability go hand in hand. Price stability, confidence in the value of money, is the bedrock of a stable, well-functioning financial system.
Did you hear that? That he is saying it is the confidence in money. Now, this is a big problem that I have because the definition of money has changed over time. In the old days, we always had gold and we always had silver. Remember, two separate things. And as we had gold and silver, they then created something called currency, but that currency always would say on it, silver certificate, that it was redeemable for money. Then they actually took that off, and now a real dollar actually doesn't say silver certificate anymore. It says note. Notice the difference. And so in the old days, this was considered money because a silver dollar was backing it up. When there is nothing backing it up, it's now called currency. So when they're talking about faith in money, that is kind of like a sly way of saying it because it's no longer money. That was the first point that I wanted to bring up. Now they're talking about the Swiss banks and the US bank collapses. Listen to this.
The United States and Switzerland are a reminder that risk can materialize and spread quickly. They highlight that the business models of some financial institutions rely too much on an environment of low interest rates and low market volatility.
Okay, so did you hear that statement that he just said right there? So number one, he is telling you that this can spread really quickly. Okay, and so we know that. And so they are prepared for it if it spreads quickly. But he says, remember, it's not too nice to talk to people, but they're always going to talk to companies, right? Because they're not living, breathing people. So he says people were getting too used to low rates and stability. So what does that mean? That you got to get used to high rates and high instability, which is where we are at right now. So we got to remember, this is one thing I just want to pause and tell you this. There is hundreds of economists that work for the Bank of Canada. There are thousands of economists that work for the bank in the United States. And they ponder over these words, thousands of people all checking it off. So when they speak, the words that they are saying have been vetted to mean a very precise meaning. And that's why we have to break it down into what things that they're actually saying. So let's move forward then to where their main risks are, okay?
Banks channel money from savers and investors to borrowers. As interest rates go up, banks need to pay savers and investors more, so the funding they use to make loans becomes more expensive. This is an intended outcome of monetary policy tightening. The increase in bank funding costs is coming at a time when sources of low-cost deposits are declining, and Canadian banks generally have more demand for loans than can be funded solely by Canadian deposits and investments.
So you guys, when they're talking about this is their number one risk on their list is essentially mortgages. That's their number one risk that they're worried about right now. So when we're going to be talking about that risk, what it actually comes down to is low liquidity. And so liquidity just means that they got cash in the bank in order to help you pay for something. But remember, you guys, that when Silicon Valley Bank collapsed, there was $20 billion that actually were lost in Canada. just from that one bank. So they lost a lot of cash. And as they lose cash, they don't have cash to go lend it out to other people. That's a big problem. And so low liquidity is their number one reason the number one reason why they're afraid. But did you know what she said? That this is intended. Did you hear those words? This is an intended consequence. This is what they want to happen. They need people to run out of cash so that they can continue to lower inflation. All right, let's go back to my next point then. We're about halfway through, just so that you know.
To return and persist, bank funding costs could rise beyond the higher levels intended by tighter monetary policy. In addition, in a severe stress situation, funding could also become harder to secure. In response, banks could likely constrain credit to households and businesses, potentially exacerbating an economic downturn.
Okay, did you hear that? This is really, really important for you guys to understand these individual points. Not only is this intended, she also says that what's happening to the banks in the United States has no impact on Canada, little or no impact, direct quote. And I made some notes, so I'm just checking my notes. And oh yeah, the compound effect. So as more and more people run out of cash, it's going to compound the problem. Banks do not have any money to lend out, and it will exacerbate the problem that's already here. So that is really, really important to know. And so let's go on. My next one, 705. This is where we're going to talk about mortgages right now and how behind people are, okay?
The third area the bank is watching closely is the ability of Canadian households to service their debt under higher interest rates. Higher debt servicing costs are stretching budgets and reducing borrowers' financial flexibility. About 1/3 of households have seen their mortgage payments increase since February 2022, just before the bank started raising the policy interest rate. More households will see their payments go up in the next few years as they renew their mortgages.
Okay, so as we get back to that, you guys, so what is she saying? 30% of places right now, 30% of Canadians have already had to get hit with these super high rates right now. And they said it's going to get a lot worse as people come up for renewals. You guys know from following me on the channel, this is what we're talking about every day, that people are coming up for the renewals and they are getting shocked, sticker shocked, 50% higher payments for those people who are on fixed rates who are coming up for renewal. All the people on variable have already gone under. Did you see the number that she said Canada has already in? We're already 30%. Please remember, in 2008, when the world financial meltdown happened, it was only 4.5% of people went into foreclosure. 4.5. It happens at the margins. It doesn't take an enormous amount of people to tip the scales. So remember that. And why would they say more and more and more people are going to be running into higher rates if they had intention on lowering the rates really quick? Because that's the number one question everyone asks. Do you think they're going to be lowering rates? Do you think they're going to be lowering rates? And they're like, it's going to be hitting you longer and longer. I have some more stuff that they talked to us about mortgage rates. It's the only thing anyone wanted to talk about. Okay, let's check out where she is talking about lenders right now.
Mortgage defaults could rise, leading to credit losses for lenders. That in turn could lead to a further pullback in credit, worsening a downturn.
Did you see that? So that if people stop making their mortgage payments, the banks will lose money and then will stop lending. There you go. So when Silicon Valley Bank made 3 Canadian banks lose $7 billion each, now that's $7 billion each that they can't go and put out in the market. As people will default on their mortgages, banks lose the money and they can no longer lend out. They're suffering a loss, right? So of course, if I lost $1,000 at the casino, I don't have $1,000 to lend you anymore. You know what I mean? So she's acknowledging that that is a mega problem. Okay, so next.
So our main message is that as the adjustment to higher interest rates continues, financial institutions need to adapt, and central banks and regulators need to be extra vigilant.
Okay. So, remember, I told you that they do not and will not talk to people as if they're talking to an individual person and tell you, you got to tighten up. It's up to people. They want to talk to faceless companies, right? And what are they saying? You have to get used to higher rates. Full stop, underline, exclamation mark, highlight. You have to get used to higher rates. I mean, I don't know how much clearer they can be. Unfortunately, I mean, that's just where we are right now. You have their main message, she says, is you need to adjust to higher rates. That's it. Okay, so we're nearing the end, and I think this is probably the biggest announcement that they made right here. Listen to this.
Signs of stress. And we have the tools needed to provide emergency liquidity if severe stresses develop. In fact, we've recently...
Did you hear that? They have the tools to provide liquidity. Did you hear that? I don't know how we could just like bowl right over that main sentence. They will print money. That's what liquidity means. They will print money if we run into a jam. Okay, so just let me back up here for a second. You printed a lot of money and caused massive inflation, and now we're trying to pull inflation down, but if it gets too tight, you're going to print a lot of money again, which causes inflation again, right? It's like a dog chasing his own tail. Anyway, but the news is it's the first time I've heard them say, we will print money. Listen, you guys know me. I'm always telling you they're going to print, but they're not going to admit it, right? But it's in their plan statements, right? That they're going to be doing that. Okay. So then listen, they go to some question periods, and they were trying to be respectful, and they told everybody, please don't talk about monetary policy, talk about financial stability, as if the two are not connected. Every single newspaper, every single person wanted to know about mortgage rates. It's the only thing that anyone wants to talk about. Everyone didn't give a damn about their financial stability report. It was actually quite funny. A couple of the reporters were joking about it. But let's hear, because they couldn't dodge the questions. They just could not dodge any of the questions. So let me get to some of the main points of the questions that came out. This is important, okay? 16. Now, this is, do you think they will cut rates? Do you believe they will cut rates? Here it is from the man himself, Big Papa Tiff.
Interest rates enough to bring inflation back to target. There is no hint of cuts in that statement. It is far too early to be thinking about interest rate cuts. Inflation is coming.
So did you hear that? He says there are no cuts. There isn't a hint of cuts. Nothing even close to cuts. Don't even think about cuts. All right. So, I mean, that is very, very, very clear, right? Also, they wanted to talk about the stress test. So for our Canadians, our Canadian friends, this is a little bit different in Canada than the United States. So in Canada, our rates right now are at 4.5. But the way that it works is that we have to test to see if you can handle a financial hit. So they'll put a certain percentage above that. So let's just say that right now, our mortgage rates are sitting at 6. You may have to qualify at 8% to make sure that you can get through any tough times. So they'll have that buffer on it. But this is the exact same as the United States, guys. They're going to be talking about, we have to have confidence in the money. Don't worry about the banks. They're going to be stable. What else did they say? That this is intended. This is exactly what the states are saying. There's going to be danger when people come up for renewal. Exactly the same statement as the states. They will print money if they need to, identical to the United States. Think nothing of cuts, identical to the United States. And this is why I'm saying, whether you're in Canada or the States, this is identical. The verbiage is identical. All right. So will they cut the stress test is the question, right? Do you think that they're going to do anything for that stress test?
OSFI, c'était le test du stress pour les hypothèques. Et un message dans notre rapport, c'est que cette politique était très utile. Et qu'est-ce que ça faisait? Quand vous faites votre application pour une hypothèque, quand les taux d'intérêt étaient très bas, l'hypothèque était testée à un taux d'intérêt à 5 et
All right, you guys.
un quart.
This guy is he's speaking in
5,.
French right now. You guys know that I'm from Montreal, so I speak French too. But he's saying it is that bump in those rates, that safety net in rates, and that it is going to stay. They're not taking it away. Okay, so what are the other ways that they could maybe keep floating? Again, they brought up again. What about rate cuts? They brought it up again. These guys have a lot of stones, to be honest with you. Okay, will you drop rates? All right, here again. Let's go.
Nobody should expect that interest rates are going to go back down to the very low levels that we've seen over the last decade or so. So we're in a transition period to a world where interest rates are going to be higher than what many people have gotten used to.
So this is what they're going to say, is that they're going to say that the rates have got to stay higher for longer. I mean, we keep hearing this over and over and over again. Well, I can tell you, first of all, that the stock markets and the bond markets do not believe this whatsoever. So everybody, and including myself, believe that the rates will go down one day. But they keep telling us, when is the magic question. I feel like when you're driving your car, and the kids are in the back and they're like, when are we going to get there? When are we going to get there? Well, I don't know when, there's traffic, but we're going there. But please remember what had to happen for rates to get down this low before. 2008 financial crisis. We had to have a pandemic. We had to have the beginnings of a massive war in 2001. What happened in New York? Something terrible has to happen for rates to go to zero. It's not going to happen because it's a Thursday afternoon and you got a McFlurry. There has to be a real reason for it. They're not going to do it otherwise. Okay, last point. In the United States, the number one product is a 30-year fixed amortization, 30-year mortgage, right? 30 years. So number one product. And it's a fixed rate. In Canada, this is completely not the same way. We normally have to renegotiate our mortgages every 1, 2, up to 5 years. But we can spread our payments over X amount of years. In Canada, max is 25 years. In America, 30 years. So we are watching in the United States. One of my flags for the United States is wait if they ever put it to 40-year mortgages. 40 years. This is could happen. But in Canada, we used to have 40 years and they took it away. They said that's very, very, very dangerous. Please remember in Canada, what happens is just let's say you had a 4-year time span here. You are never allowed to renew your mortgage more than a 25-year payment schedule or amortization. 25 years. That's it. But these are the walls inside of these two walls. So say you're 1 year into your mortgage, 1 year in, okay? Then you could start messing with the payments and they could make it 70 years, 90 years. I even saw a client with a 100-year amortization. Pay it for 100 years. Can you believe that? But listen, it's not 100 years. That's just the temporary payments. As he's getting close to the other wall over here, as soon as he comes up for renewal, whenever that is, all those prices have to snap back to 25 years. It is a temporary, very, very temporary thing. And so there could be a tsunami of trouble that is coming down the road. And she wants to address that, whether or not they think that it would be okay. Would it be okay if they did that? Okay. And here is her question, because everybody and their dog is asking me this question every single day. Please listen.
A buffer that households can use if they find their payments go up and squeeze their budgets more than they can deal with. So amortization is a good sort of release valve to help deal with temporary increase in payments. The Financial Consumer Agency of Canada recently put out a really helpful guideline to make sure that Canadians understand that they can talk to their lenders about extending the amortization as one way to cope with higher payments if they're finding that it's putting too much stress on their budgets. The point that I think you're asking about is what about just structurally changing amortizations and increasing them across the board? We don't think that's a good idea for exactly the reason that removes the buffer that households have when it comes when they face stress. So if we,
And so there you go, straight from the horse's mouth. Okay. They are not going to extend the amortizations. It's not going to happen. I didn't think that they're going to do it either, but this is where we're at right now. So let me share this with you. I just started writing it all out for you, and I want you to pay attention to this, and then you guys could let me know what points that you saw. I'd love to see in the comments below. Number one, confidence in money. You guys know that I think that is a bunch of malarkey, because currency is not money. Okay. Currency is just a piece of paper, and all they have is faith. That's why they keep talking about we need confidence in money. Money has something of value. A piece of paper is just a piece of paper. Number two point that I wanted to have, volatility spreads, and it spreads quick. So look at what happened to the banks in the United States. When they're about to collapse, they're going to go down very fast. Things happen quickly. Number three, I wrote down, do not count on low rates. There is nothing to show you that low rates are there. Remember, low rates will happen when there's an emergency in the system. But if you're in an emergency system, you may not have an employer anymore. You may not have a job anymore. Your company might get shut down. And so it may be a very, very bad position that you're in if you're banking on low rates. So what were their risks that they had? Their risks is low liquidity, meaning the banks have no money. The banks are completely out of cash. So if the banks are completely out of cash, they have nothing to lend you, right? And the other key is this is intended, my friends. They want this to happen. So because they want this to happen, you can't expect it to change right now. Number two, they're talking about mortgages. They're big risk. 1/3 of people have already had their payments up 50%, which is insanity. Remember, please, I'm putting a star here. 4.5% was how many homes in the US collapsed during the 2008 meltdown. It's easy that 4.5% could be right in this first third, but there's a lot more coming. And they're afraid of those renewals that are coming due. Within a couple of years, you're going to be at 60% of Canada will have payments that are 50% over. Trust me, there's going to be a lot more cracks in the system in that. They're very afraid of extended amortizations. Some over 100 years, like I had told you. The extended amortizations, she used the word, it's a buffer only. So you're going to get the smackdown once your renewals come up to due and your prices get snapped back. Big problem. Okay, so what do we have to do? Well, we have to adjust to higher rates. You, I, every business. Charlie Munger and Warren Buffett just had their meeting. And when they had their meeting, they were talking about all the homes and all of the buildings that are suffering huge, huge losses. And Charlie Munger just said, the only thing I know is that all buildings will have a different name on them from now on. He's meaning that the people who own them now are going to lose so much that they're going to be seeing that. And I did a whole video on commercial real estate and the dangers of that. So you can go on my channel and Rough Team Realty and check that out. So adjust to higher rates. They will, bombshell announcement, will print more money if needed. But guys, I also say this like it's a bombshell that is out there. I know I'm not trying to be flamboyant about it, but we also always knew that they would print money. They always print money. The choice is only to default or inflate. There's only two choices, and they never default. In the United States' entire history, in Canada's entire history, they do not default. So we always know that they're going to print. Yes, we always know that they're going to lower rates if we're in serious doo-doo, okay? And it hits the fan. We always know that, but they just never say it. Do you know what I mean? Because if they say, just think about this, if they say that rates will go lower next year, everybody and their dog will wait to buy a home until next year. If they said inflation was going to be really hot, everyone would run out to the store right now and buy everything now because the prices would skyrocket. So, you know, they're carefully choosing their words to not cause a panic in the market. So this, I thought that was important. The stress test, everybody in Canada always asks me about the stress test. I'm glad that they announced it because I said that it was going to stay, absolutely. but now they were specifically asked, and they said the stress test will stay. They said rates will stay high. But honestly, what else are they supposed to say? I know they're going to say that. Of course, they're going to say that. And the other question of longer amortizations, so this 100-year crap that we hear right now, it's just a temporary buffer. The maximum when you renew, I have to add the word in renew, is 25 years. That's what you got to know. If you're in Canada, the maximum is 25 years. So please remember that right now, okay? And I'm going to just add one extra thing, and this is my David thing at the bottom, okay? Because this is the other question that I'm getting all the time. So when we're going for a mortgage right now, let's say, Julia is going to get a mortgage, and she gets a rate given to her at 6.2%, okay? Now let's just say it's in Canada. So what they do is they go and get this money from the Bank of Canada at 4.5. And what is their profit margin on that right now? The profit margin is 1.7% right here. So they'll give it to Julie for 6.2, but they're borrowing the money at 4.5 from the bank, and then they're going to give it to you to 6.2, right? So when you're paying your mortgage rate, you're actually paying two rates. If you're the Federal Reserve in the States, for example, right now it's at 5.25, but maybe they'll give you a rate at 7% or something like that. So, there's one part that is commission, and there's one part from the central bank. Got it? Cool. So what we're seeing right now is that the Bank of Canada rate is going up and up and up, and we're seeing the US bank just go up and up and up. Okay, that's the central bank. So this could be the Federal Reserve and the Bank of Canada. So the profit margin, they always want it to be somewhere around 2%, like this. It kind of follows it, and it's always around 2%. But what's happened now when all these banks collapsed is they're now willing to take a very close, I'm going to put an arrow there, like maybe 0.5%. So when you see in the articles, you'll see two different articles on the same day that mortgage rates are going up and mortgage rates are coming down. And everybody gets very, very confused by this. So the central bank of your country or the Federal Reserve in the States could still be raising the rates. We know that the US Federal Reserve is at 5.25 right now. But where it is when all these banks were collapsing, they now have decided to take a smaller commission on their mortgages. So that's where banks have gone down. Let me give you another example that might seem a little bit easier. I used to sell cars, okay? And just let's say that this is a Lexus car. When I have a Lexus car, we would sell it for around $55,000. Cool? But the profit margin on the car was $5,000. So the cost was $50,000 cost, and there was $5,000 profit. Cool? So imagine in this scenario that I'm going to give you right here, that the car now is $54,000 and the cost of the car is $51,000 and the profit is only $3,000. Can you see in this example, number one, the price of the car has gone down overall. The cost of the car has gone up, but the profit margin is what sank. Can you see that example? So if you're selling that car, when we go buy our mortgage, all we care about is this final number. And that's all that you're seeing is that the rates are lower. But you have to ask yourself, well, why is it lower? Where is the cost coming? But the cost is going up. It's the profit margin down here that's getting squeezed. I hope that helps you guys because it's the number one question that I get on a regular basis. Will we be raising rates in June is the other question that we get all the time in Canada. Why are we going to be raising it? In the United States, will they be raising the rates? Good questions all around. I wish I had a crystal ball, man. I'd make a lot of money with that. They always say that they're going to bring the rates down to 2%. They will not stop. Okay. And they said, what we look at is inflation, core inflation, and jobs report. So if their inflation comes in very high, core inflation comes in high, jobs comes in high, what can they say? They look like idiots if they don't raise the rates. So I don't know. So I would say that they're probably going to do it. Let's see. The only thing that they're counting on in Canada and the States is the lag effect. Will the lag effect keep coming? Guys, we got a long time for that lag effect to actually come on. Normally it takes 18 months after the last interest rate hike. 18 months after the last interest rate hike. We're only a couple months in. So, you know, I'm wearing my shirt today. I know this is Star Wars, but you see, support our troops. I feel that we are all troops. We're going to battle right now, but a financial battle for survival. We need to keep fighting. Guys, you guys know me. I've had a really tough life. I was on welfare. I had cancer 2 times. I have a lot of organ problems. My dad just told me that we win because we don't quit. We never quit. And I want you to never quit. Just keep on learning, keep on fighting, because this is going to hurt a lot of people. And I don't want you to be one of them. Anyway, you guys, thanks so much. Please pay attention. Next 2 years is going to dictate the next 20 years of your life. Please remember to like and subscribe. I really appreciate you. Thanks for everything.